Hey everyone, welcome. Today, we're going to dive into one of the most popular tools in any trader's toolkit, Bollinger Bands. Now, they might look kind of complicated at first glance, but trust me, by the end of this, you'll see them as a super powerful way to understand the market's mood, from calm to chaotic. So, let's dive right in. All right, so let me ask you a question. How can you look at a chart and get an instant feel for what's going on? Is the market just sleeping? Is it going wild, or is it maybe, just maybe, coiling up for a huge breakout? That's the exact problem Bollinger Bands were designed to help us solve. Okay, so first things first, we've got to understand what we're even looking at on the screen. Let's break down the anatomy of these bands. All right, check this out. See that price action right there? It's kind of hugged by these three lines, right? You've got an upper one, a lower one, and one right down the middle. Together, they create this dynamic channel that literally moves and breathes with the price. So, what exactly are these lines? Well, that middle band, it's just a simple moving average. Think of it as the average price over a certain time. It's our baseline. And the upper and lower bands, they're basically statistical boundaries, a couple of standard deviations away from the middle. All that really means is they create a channel that tells us what's normal for the price. And that right there brings us to the most important fundamental rule of Bollinger Bands. Because of that math, the price is going to hang out inside those bands almost all of the time. That's our baseline. That's what normal looks like. Okay, so now that we know what they are, let's get to the fun part, learning to speak their language. How do we actually read these things to understand volatility and trend? You know, this is actually super intuitive once you get it. I want you to think of the bands like the banks of a river. It makes perfect sense. When that river is calm and slow, the banks are close together, right? That's low volatility. But when there's a flood, a raging river, the banks get super wide. That's high volatility. It's that simple. Narrow bands need a quiet market. Wide bands, things are getting wild. But it's not just about volatility. These bands are absolutely incredible for spotting strong trends. This chart shows a perfect example of what traders call walking the band. So here's the deal. When you see the price just hugging that upper band, constantly touching it, riding it up, that's a huge confirmation of a strong uptrend. It's basically screaming at you that the buyers are in complete control. And of course, the same thing goes in reverse for a downtrend along that lower band. Now, that middle band, it's more than just an average. It's kind of like a line in the sand. If the price is hanging out above it, the mood is bullish. If it's trading below, yeah, the mood's bearish. Just think of that middle line as a moving floor or ceiling for the price. All right, now this is where things get really interesting. We're going to talk about one of the most powerful signals these bands can give you. It's literally the calm before the storm. This signal has a great name. It's called the squeeze. So what is it? A squeeze is what happens when volatility just dries up. It gets super, super low, the market goes quiet, it just chops sideways, and all that time, it's building up energy for its next big move. Just look at this chart. You can see it clear as day. See how those upper and lower bands are pinching inward? They're getting super tight around the price. This is our river we talked about. It's getting really, really narrow. And that's your visual cue. It's a warning that a big move is probably just around the corner. So the pattern is actually really simple to spot. First, the bands squeeze together. That's your low volatility. Then the price just kind of goes sideways for a bit. And third, this is what everyone's waiting for. You get a massive breakout, either up or down. The squeeze is your heads up. It's telling you to pay attention because something's about to happen. And hey, here's a pro tip for you. When that breakout finally happens, you gotta look at the volume. If you see a breakout on a huge spike in volume, that's a much, much stronger signal. It tells you there's real conviction, real power behind that move. Okay, so as powerful as all this stuff is, and it is powerful, no indicator is a magic bullet, right? It is absolutely crucial to use these bands with some discipline and some caution. And that brings us to our final and maybe most important set of rules. And here's the biggest one, for sure. Do not use Bollinger Bands in isolation, ever. Just because the price touches the upper band, that is not a signal to sell. It's just not. Smart traders are always looking for what we call confluence. They want confirmation. They'll combine the bands with other tools, maybe an indicator like the RSI or MACD or classic chart patterns, to really build a strong case before they ever put on a trade. But look, out of all the rules, all the strategies, there is one that stands above all the rest. It is completely 100% non-negotiable. Always use a stop loss. I don't care how perfect a setup looks. I don't care how much confirmation you have. The market can and will do the craziest things you can imagine. Your number one job is to protect your capital. That's it. And a stop loss, that's your safety net, always. So let's wrap this up with one final thought. Bollinger Bands are incredible tools. They show you what the market is doing. Is it trending? Is it quiet? Is it about to explode? But true mastery, that comes when you start asking why. Why is it doing that? What's the news? What's the story behind the price action? The bands give you an amazing map, but it's still up to you to understand the territory. Thanks for joining me.